Good afternoon, ladies and gentlemen, and welcome to today's presentation. Of course, I want to say good afternoon to those of you joining me here along the East Coast. It's just after 12 noon Eastern Time. I'll say good morning to those of you who are in the more Western time zones here in the continental U.S. And of course, good evening to those of you who may be joining us from across the pond in parts of UK or parts of Europe. Welcome to today's webinar again. Why should I insure my stock? There's a lot of different ways out there to maybe insure a stock position, or even trades out there as options investors we know that have a limited risk, or what's taught as a limited risk. Well, this is a common question and an answer, of course, that has more benefits than more negatives when insuring your stock position done correctly and in the proper structure. Now, for those of you who don't know me, my name is Mike Chupka. I am the Director of Education here at Power Options and Radioactive Trading. For those of you that don't know, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. I've been trading since 2001, and I've extensively traded for extended periods of time, covered calls, in the money, at the money, and out of the money, cash-secured naked puts, straddles and strangles, call and put buying and swinging back and forth between the two, vertical spreads, bear call credits, bull put credits, calendar spreads, and of course just straight stock positions before I got into options. Now what I want to cover today, of course, is the main problem that faces all investors, whether you're just buying stock, whether you are doing cash secured naked puts to get in a stock at a discount. Maybe you're dabbling a little bit with covered calls, or maybe you're even an experienced spreads trader. We're also going to talk about why the problem hasn't been solved that we may face as investors, and of course our solution for that problem to get better returns long-term on our positions, and then of course we'll also show what is possible as well. Now before I go any further, I just want to know, a quick question here. I want to know, what is your level of participation so far with Power Options, with the radioactive trading concepts, or both? Are you currently a Power Options subscriber or trial member? Is this your first time attending one of our webinars for Power Options or radioactive trading? Have you been to other radioactive trading webinars in the past? Are you considering purchasing the blueprint or the home study kit, or have you recently bought the blueprint? Okay, so we've got a fair mix here from our attendees, and we've got over 70% of our attendees have answered the poll already, so I'm going to leave it open for another 15 to 20 seconds here. I don't want to spend too much time on the polls there. All right, let me go ahead and close the poll, and we'll share the results. So we've got a fair mix here. There we go. 33% of you are current Power Options subscriber or trial members. Now 17% of you, this is the first time joining us for radioactive trading presentation. Welcome. Hope we give you some new trading ideas today. 33% of you have been to other radioactive trading webinars, and 50% of you have recently bought the blueprint. Okay, so we're going to review the basic concepts here for some of you, but also introduce a new concept to some of you as well. And at the same time, we're also going to discuss some trading ideas and trading prospects, I should say. So let me go ahead and hide the results, and let's go ahead and move on. Now, whether you've been to one of these webinars before or you're just coming for the first time, what are the main problems that we face as investors? Well, we all know the answer. We just don't know the future. We can't know the future, regardless of your stock selection process. Technical and fundamental indicators, what you see on a service you might be paying for that shows you little green arrows to buy and little red arrows to sell and so forth, we can't know the future. If we knew the future, it would already be priced in. Regardless, if you're currently just buying stock and maybe using a stop order, or you're doing covered calls, or spread trades, or maybe even four-leg positions, iron condors or butterflies, in any investment strategy you approach, you're going to have unexpected events, and you're going to have strings of winners and losers. I can see someone posting emails such as we do, to our client base, saying that, hey, we've got a 97% success rate over the past 5 months. See how we've managed these returns. Well, that's great. But we all know that the market conditions 5 months ago are not going to be the market conditions 5 months down the road. Market is dynamic and ever-changing. And we also know that when we hit losses from an unexpected event, it's sharp, it's quick, and it's usually a lot higher than we expected originally. And our gains, of course, are more gradual. Now, where does this lead us to? It leads us to the problem that taking any loss actually compounds other problems faster than we thought. When you look at any investment structure, any investment, the math does not behave the way we expect it to. If I take a 10% loss on a position, I don't need a 10% gain to get back to break even. I actually need about an 11% gain. So if I had a portfolio of $100,000, I invested all of it and I took a loss of 10%, well, my account's now down to $90,000. If I make 10% of what I have left, I'm only back to $99,000. I'm still short. So I actually need an 11.1% risk. And those of you who maybe trade leverage positions, credit spreads or buying calls and puts, if you take a 25% loss, well, you need a 33% gain to get back to break even. And if you suffer a 50% loss, you're going to need a 100% gain on what you have left. But when we consider controlling risk with insurance, properly structured, if I suffer a 5% loss on a position, I don't need a 10% gain. Divide by 10 here from 50 to 100. If I take a 5% loss, I only need a 5.3% gain to get back to break even. And those of you that are using stops or trailing stops, you have a sudden event, not even earnings, something that happened overnight, some bad news came out about the company, rumors of the CEO leaving or a pending patent lawsuit, something along those lines. If you set a 7% stop order on your stock or maybe your covered call, if there's a sudden 25% decline, at market open, you get filled at that 25% loss. The stop order is violated. They can't give you that price anymore. You get where the market's trading. So you still take that 25% loss in your position, and now you need a 33% gain. Stop orders are typically assumed insurance. Okay? So why hasn't the problem been solved? Well, quite simply, we've been looking in the wrong place. And there's nothing wrong with that. Our goals are to profit and make money. We want to find the positions that maybe lower our cost basis when we get into a position and possibly can guarantee us a strong return. See income coming in and look for that good percentage return for a 5-day using weeklies, maybe a 14-day trade to keep it short term, or even a 30 or 60 or 90-day trade. You're going to look for a scheduled return, a calculated return that matches your trading plan. But a lot of this is based on unrealistic goals. And what do I mean by that? I've seen services out there that teach covered calls where they talk about making 3 to 6% every 30 days. Okay, well, if it was that easy, if everyone could make 3 to 6% on their covered calls consistently on almost every trade, then everyone would be doing it. I've seen people tout a 95% success rate on credit spreads where they're making 100%. Well, they're not making 100%. They're generating a premium of 25 or 30 or 40 cents on a position that has a 5-point risk, taking a 10-to-1 risk-reward ratio. And they made the 40 cents because it expired. Okay, so that's 100%. What they're not likely showing you is that they have positions that took a loss and they rolled it out 8 or 9 months in time. So it's not a loss yet. They're just really hoping that it comes to fruition later on with less of a loss than they took right now because they know one loss on that leverage credit spread could wipe out 10 or 12 previous trades. That's almost a month of work, likely 2 months of work as well. So taking that idea a little bit further, here's an email I received the other day. A customer sent in that I would like to sell options just to get the premiums. Not interested in stock capital gains or appreciation. Well, do you know of a safe way that I can combine options just to earn the premiums? Well, there are different ways to do that. We all know that. And likely one asked before, but does it solve the problem? The most common approach discussed by brokers when you're getting into options is a covered call. It is the most popular option strategy. Why? Well, those of you who are maybe even doing credit spreads right now, or you're buying calls or buying puts around earnings, or maybe straddles or strangles around the current earnings events today, or this month I should say, you probably have stocks in your account where you're selling covered calls. Just against it, get a little bit of premium, hope it expires worthless maybe, and you're just going to keep that core holding in your account. Those of you who just got into options, you're being told that, hey, this is a great way to rent out your stock, generate a premium and give you some downside protection and still offer a good return. Well, the problem is it's taught as a safer strategy, but it really isn't. Okay, if I own stock and I sell a call against it, what have I done? Well, I've capped my gain to the upside of the position. If the stock jumps up quickly, what I end up seeing is the fact that unless I pay more money to buy to close the call, I don't get any further upside. And sure, you might have generated 2, 3, or 4%, but that still means you're risking 98, 97, or 96% of the risk you had in the stock ownership as well. And it has the same risk-reward profile as a naked put. On both strategies, you can go more conservative. We can sell in-the-money covered calls for a lower return but a higher protection. Selling out-of-the-money naked puts, get a lower premium, but the stock has to fall further before you're losing on the position. So as a general investment approach, think about this. What are we doing? With a covered call or a cash-secured naked put, we're capping the gain, but we're still taking on pretty much the same risk of owning the stock outright. Now, sure, it's a bullish strategy. That is true. It's a neutral to bullish position. It's more neutral, really, because if the stock runs up 8%, I don't only want to make 2%, I'd like to make more. But I'm going to have to pay more to get that. Is it safer? I don't agree with that. It's a little bit safer than owning the stock outright. The naked put might get you into the stock at a discounted price, but you're still taking a lot of risk. And yes, the reward is limited. But as an investment strategy, just look at the structure. It cuts your winners short and still allows your losers to run. That's not likely a great long-term approach, okay? Now, here's a basic opportunity. We're going to run some comparisons today. Here's a basic covered call opportunity from about 20 days ago, 15 days ago. On April 26th, stock AEIS is trading at around 72.50. I could have done a speculative covered call. I could have bought shares of stock at 72.50, and then I could have sold the May expiration, about 8 days away, 75 call for $1.55. Now this reduces my cost basis from 72.50 down to 70.95. That's also my break even. And if I get assigned at 75, I'm going to make 405 from my cost basis. I'll get 75 back, and that's going to be a 5.7% return. Almost a 6% return for less than 30 days. Now this downside protection, what does that mean? Well, I collected $1.55 against a 72.50 investment. So that means the stock can fall 155 or 2.1% before I'm losing money on the transaction. Okay, well, where are we today? Well, here's the profit and loss chart of the potential covered call. And AIS moved up today close to $78. Last I looked, it was around $77.95. So if it holds this price in 8 days, well, I'm going to be looking at a reasonable return of 5.7%. What can happen in the next 8 days? Who knows? The stock could go to 80, could go to 82 or 83. The stock could pull back, drop down to 72, 73, or $71 per share. Now our break even here, that's at 70.95. We've still got about 10% drop before we could lose money on this position. And we're still making a good, reasonable return. Okay? But long term, is the structure going to satisfy our needs? Well, let's take a look at another example. Here's a question I had from a coaching session last week. Someone says, I see plenty of weekly credit spreads, short term, 7, 14, maybe even 20 days out in time, offering a double-digit return with an 80% probability. What could go wrong? Why doesn't everyone trade this way? Well, again, it's because the math doesn't behave the way we want it to. If I'm taking a 10 or 11% return with an 80% probability, well, an 11.1% return would be making 50 cents on a credit spread on a 5-point risk. My true risk would be about 450, so 5-point spread, taking 50 cents. Okay? So here's a typical look at a bear call credit spread. The bull put credit spread would have a switched profit and loss chart. We'll look at that in a moment. Does this have a limited loss dialed in? Yes. If I open a bear call credit spread or a bull put credit spread today, and I make a 50-cent net credit on a 5-point spread, my true risk is only 450. So that's the most I could lose on a position. If I did one contract, I'd only lose $450 if it took the maximum loss. If I did 10 contracts, it'd be $4,500, but I know the risk going in. The problem isn't that this offers a limited risk. The problem is that we don't allow the winners to run, but we're still looking at a double-digit return. The problem is when you look for a spread that has an 80% probability, you're probably looking at a structure here that's offering about an 11 or 12% return, 50 cents on 450. But that's a 9-to-1 risk-reward ratio. If one position goes against you for the full loss from an unexpected event, you've now wiped out 9 previous gains with the structure of your trade. So even with an 80% probability, you actually need to be right 90% sometimes or more to profit long term. Okay? James puts a comment in here. He says the loss could be slightly higher than the difference because the market makers have their markup. In general, we'll take a look at that a little bit, but in general, the worst case scenario would be the maximum loss. I have never come across a situation where even if the stock rose, let's say above both strikes, James, of my bear call spread, that I'd get out for worse than the 450. Now, it depends on how I leg out of the position or if I don't use a limit order to try to get the midpoint price. Now, he might not fill me at the midpoint price, you're right. But even if I just left it to expiration and got closed out, I get closed out even for the full loss at the intrinsic values on the position. I'll talk about that in a moment when we look at the bull put. So that means that even if there was a wide range, I could wait a couple days, hold it to expiration, and I couldn't lose more than that amount. Okay? But that does come with some caveats as well. Now, same idea. Same stock, AEIS at 72.50 on April 26th. Again, a 21, 22 day out trade. I could have opened a bull put credit spread on AEIS by selling the May 70 put for $1.45. And at the same time, we could have bought the May 65 for 75 cents. Right? So now I take in a net credit of 70 cents on this position. Now the most I can lose is 430. So my return, my credit, if I receive it, if the stock stays above 70, both options expire worthless, off of the 430 investment I'd have to put up for this trade. Well, I'm looking at a potential 16.2% yield. And this is a little bit lower. It's a 70% probability. On this particular stock, we would have seen an 8% return going to the 65 and 60 with about a 92% probability. So that probably wasn't in your range. If you're doing leveraged spreads, you're looking for a little bit higher return. Okay? James, is this referred to as a collar? No, this is not. This is a straight leverage spread that has a similar risk-reward profile to a collar. Okay, so here we are looking at AEIS now, but here's our bull put. If I sold the 70 put here, remember that was $1.45, and here we bought the 65. So if AEIS falls below 65 in the next 8 days, we take the full loss of 430. Why? Well, because I'd be forced to buy shares of stock at 70. I've bought the right to sell them at 65. So if I did nothing and the stock was at 63 at expiration, my broker would automatically buy shares of AEIS for me at 70 and then sell them at 65. I take a 5-point loss. But regardless of what happens, we keep that 70-cent credit. It's deposited in our account, so we only lose 430. But keep in mind, this is a 6-to-1 risk-reward ratio. If I set up similar structure looking for a 16% return with a 70% probability, this one loss would have wiped out 6 previous trades. It probably took out a month worth of profits for this strategy. Okay? Now, is it safer because the loss is dialed in? Well, yeah, you know the loss, but at the same time, the leverage of the spread and setting up the probability means you're taking on a high risk-reward ratio. Okay? Now, James, to your question, a collar would have a similar structure. But let's say in the collar I bought the stock at $72.50. Maybe I sold the in-the-money 70 call for $3. Okay? And we bought the 65 put for 25 cents. So I got a 25-cent net credit. So if the stock stays above 70 and we get assigned, we'd maybe make, let's call it 1% return. Maybe less than that actually, but we'll just call it 1%. But now with the collar, if the stock fell below 65, I'm probably only taking a risk of maybe about 2% or 2.5. That's a common structure of a collar. The risk-reward profile looks similar. You're not using leverage, but again, did you allow the winners to run? No, you've capped the gain just as you did in a covered call, although you did control the risk. But we'll talk about that also in a little bit as well. So collar, similar risk-reward profile. All right, now, so what are our two bullish trades here? Well, we could have done a covered call. We could have bought 100 shares of stock at $72.50, sold that May 75 call for $1.55. We have a 2.1 downside protection, but we're speculating on a stock movement up, and it offers a 5.7% return. But we left the downside open. So some of you might have been putting a stop order here at around 8%. Okay? The bull put spread, we know we have a 16.2% return, and we're looking at about a 70% probability at a 6-to-1 risk-reward ratio. Okay? So why isn't that better? What are we missing? Why aren't we being successful with these types of covered calls? Well, we're going to go over to radioactivetrading.com right now, and we're going to take a look at what we call the trade simulator tool. And what the trade simulator tool is going to simulate a win-loss ratio. If we took a coin, flipped it 100 times, heads we win, tails we lose, we can adjust the probability, we can adjust the return on the positions, and this is going to allow us to run a quick comparison of why the math doesn't work the way we want. Okay, so let's go over to radioactivetrading.com. And what I'm going to do at radioactivetrading.com up at the top here, I'm going to click on the Resources tab. Here you can, of course, take a 14-day free trial to Power Options. But down below is our Trade Simulator tool. I'm just going to click in the box there. Now, the simple parameters of this tool. It's going to allow me to set in a target return for my position. We're also going to be able to set a loss limit as well. And we can set the probability of loss, win-loss ratio, talk about probabilities for spread trades and other strategies also. And we're going to take a starting amount of capital and how much we're going to invest in each position. So what are we seeing here? Well, let's take just a straight stock portfolio. You buy a batch of stocks, 5 stocks, 8 stocks, 10 stocks, whatever. And let's say that we're going to take $10,000 to start with, and we're going to invest 33%. We're going to buy 3 stocks with our $10,000, so the price range would be under 33. But let's go ahead and put our invested per trade down to 33%. Now, we're going to set our target return at 10%. What does that mean? If my stock gains 10%, regardless of if I'm in it for 2 months or 1 month or 10 days, I'm going to close it at the top. I'm also going to use a stop order. I'm going to set that stop order at 10%. So if the stock falls 10%, I'm going to get out of it. Now, we don't have any probabilities. We don't have, any expectations, so we just put in a batch of stocks. We'll run this, and we'll leave the probability at 50%. Heads we win, and we make 10%. Tails we lose 10%. Okay, so we see here, being right a little bit more than wrong, we might get a 10% return based on the strings of winners and losers over 100 times. Okay, do that again, 53, 47. So if we get 57 wins, we're really good. Okay, but even being right a little bit more, 51% of the time, naturally you're not getting ahead because these 10% losses actually need an 11% gain to get back to break even. There we go. And of course, if you have more losers than winners. So as options traders, we know there are these ways that we can hedge our losses. Let's think about our covered call on AEIS. We could potentially make a target return of 5.7%. That was the percent if assigned for our out-of-the-money covered call. And we had a 2% downside protection. So let's say that we looked at the 10% loss in the stock, which would only be an 8% loss. Now, if we take that structure with a 50-50 win-loss ratio, we see here, because we capped the gains, even if we're right more often than wrong, we're still down about 20% from our starting point. And that's not investing 100% into each trade, okay? That's taking a third into each trade and trying to spread it out a little bit. The numbers would be more disastrous if we did 100% on the trades, okay? So what do we need to do to be profitable with this structure? We're going to have to be right more than wrong. Let's set our probability of loss down to 40%. And remember, this was an out-of-the-money covered call. We were looking at AEIS at 72.50 and selling the 75 strike call, which probably only had a 40%, 35% probability of being assigned. Okay, we saw it was going to be assigned. But even here, being right 57% of the time, using a stop order of 8%, we're still not ahead. I got to get up to 60%. There's one. 71% winners. Now, true, we take our account up by about 70%, but we need to be right 70% of the time. I want to get a more realistic number. See, there's a winner. Even looking for that high target return on a covered call trading plan, which is speculative. We're not looking at a 60% win ratio. You're probably only looking at a 40% win ratio. But limiting your loss to 8%, assuming the stop order works and it doesn't get violated, you still need to be right more than 60% of the time. Now let's think about a more structured covered call. Instead of being speculative, I might have bought AEIS at 72.50 and sold the 1 month out 70 strike call, slightly in the money, and let's say I got a return of 2.5%. I would have had a downside protection closer to 5% or 4.5%. So let's say I used a 10% stop order, which means my true loss would only be about 6%, or I'll even put it at 5.5. Now we're expecting a probability slightly in the money of greater than 60%. Okay, but notice here, even if I'm right 59% of the time, I'm still down because the wins are not countering the losses, even with the higher downside protection. There we go, 65% winners. My account's down 10%. Okay, so this is, those of you doing covered calls, this is explaining why you're not getting ahead. It's because of the structure of the trade. And in this situation, I think it's going to be closer to 70. I'm going to knock this down to 35. Probability of loss here. There we go. So you need to be right 70% of the time in order to profit long term because of the structure of the trade. Now, speaking of 35% probability of loss, 65% winners, what about our leverage spread trades? Now, we saw a range of 16.2% with a 70% probability. I'm going to drop the return down to 15% and say, what if we had a 75% probability, so we only took a 25% loss ratio? But remember the spread. The max loss occurs if it falls below both strike prices. Well, we're probably going to manage that at some point. We're not going to allow it to take the full loss, but of what we invested in each trade. So here I'm investing $3,000 into each bear call spread or bull put spread, 3,300. Well, if the stock moves against me, instead of taking that $4.50 loss, I might only take a $2 loss or a $2.25, but that would still be 50% of my loss on the spread. So we're going to look to make 15% when we're right. We're going to control our losses to 50% when we're wrong, and we're going to be right 75% of the time because we're looking for spreads that have a 75% probability. Okay? All right, so what do we see? Here being right 73% of the time, you're at about a 75% loss. Okay? 71%, we need to be higher, don't we? I need closer to 79. Here being right 76% of the time, we're still at a loss of 50%. So that win-loss ratio is going to cut it. I'm going to need to go to that 80% probability on the positions. And here it gets even worse. If I have a string of losers right off the bat, well, that's going to lose exponentially as well. Okay. Sorry, quick question come in from James again. And he asked, has your data shown that you close out the trade when you're 50% profitable, the returns increase exponentially? Well, James, this is something you're gonna be able to play with. You can go to this at any time. Just go to radioactivetrading.com, click on the resources, and you can plug in your numbers based on, do you want to change it to a 5% gain, but you get it more often, and so forth. Okay. Quickly, remember what I talked about, looking for that 80% probability. That in general, I might expect to see a return of 50 cents on a risk of 5 points, which would be an 11.1% return. Okay, I'm sorry, we're going to take the probability of loss, my apologies, down to 20. And at the same time, looking at the target return of 11%, and let's say we only take a 40% loss. We don't allow the loss in the spread to get to 50%, and we're right 80% of the time. Well, here we're only right 77%, and your account's down 40%. Oops. Oh, hold on, there we go. There we go, 87% of the time, triples our money. A little bit more than triples it, okay? There we go, 80%. Okay, so here's a spread trade. You look for positions that had an 80% probability, looking for 50 cents on a 5-point spread, an 11.1% return. And your stop, you're not going to take the 450 loss. You're going to close it out if it gets to a 175 or a $2 loss, 40% of the maximum risk. Even if you're right 80% of the time, you're only making a small profit after the strings of winners and losers. So why isn't everyone trading with spreads that offer an 80% probability and a double-digit return? It's because the math does not behave the way you expect it. There you go. I need to be right 82 or 83% of the time, and that's assuming I never take a full loss and I control any loss that happens in my strings of winners and losers to only 40% of the difference in strike prices. That's very difficult. You will take the full loss occasionally, especially if you're trading it on stock positions as well. Okay, so that's why things aren't performing the way we want them to. That's why we're not getting ahead as much as you expect, whether you're doing covered calls, which would have a similar outcome to cash secured naked puts on the trade simulator. We saw how disastrous spreads could be also. So is the solution to our problem better stock technicals? Well, we already talked about indicators that work for the past 5 months probably aren't going to be the same that work 5 months from now because the market is dynamic. Yeah, common question I get, especially over the past 3 weeks, is, are we at the market top? Has the market topped out? Is it going to start to fall? I don't have the answer. Some of the techniques I trade are the same way as well, okay? And that's what we're looking to do here. So is it the fundamentals or the technicals? Well, not really. But how many of us have seen positions where the fundamentals perform the way you wanted to, for example, and You had a positive earnings. Your stock that you were tracking beat estimates, beat revenue, and increased their outlook for the next quarter and maybe even increased their dividend, but the stock fell 6%, 7% at the open because profit taking happened and people just moved out. But reverse, you may have a stock that missed earnings. Okay, you may have a stock that didn't beat their expectations, revenue was in line, but it goes up 5%. It can happen. So another thing that I've seen happen recently, a customer of mine was in a couple of positions in a given sector. His stocks were good and quality and had good earnings, but the largest of the stock in that sector or industry did not have good earnings and fell, and it pulled everything down with it. So his stocks were losing even though they were performing well because the sector looked weak. Okay, so is the answer better exit and entry points? Well, maybe it is, maybe a little bit better timing. Do our current strategies solve this position? Does using a stop order on a covered call necessarily give you a better exit or entry? Not really. Why? Because it can still get violated. You could still take a 20% loss on a position. If the stock fell, your stop order is violated. Does having a better downside protection, selling an in-the-money covered call for a higher premium, solve the problem? Well, sure, the stock needs to fall further now before you're losing money on the position, but now you're only taking a 1% gain when you're right. You're going to need to be right closer to 80% of the time, 85% of the time in order to profit long term. So it's the structure of the trade that solves the problem. Okay? Our solution is looking at the protective put position or married put. Instead of looking for the capped return, where we're hoping to make 2 or 3% if we're right and hope that 70% of the time that happens, and we only take a 7 or 8% loss on the downside when we're wrong, we control the risk up front to single digits and leave the upside open. Now, the structure of a married put is commonly taught as buy a stock. So in our example, I might look to buy shares of stock of AEIS at $72.50 back on April 26th, and then buy an out-of-the-money near-term put. What does that mean? It means I maybe buy the 70 put for May and only pay 80 cents or 90 cents. Well, the problem is that doesn't put time on our side. It's a short-term trade. It's safer. It's still bullish, as our other two strategies we looked at, a bull put credit spread and the covered call. But as what we know as investors, that when we're selling premium, we want to be selling short-term to get a better annualized return. If you sell week by week by week or month by month by month, you get a better annualized return. But if you buy month by month or week by week, you're paying a higher annualized cost. The option that is 6 months out in time is not 6 times the cost, which is why we're selling near term, because selling an October covered call right now would give me a high premium up front, but it would give me a lower annualized return, and a lot can happen in 5 months. Whereas on the married put, if I buy 6 months out in time, I'm not paying 6 times the cost. I have a lower cost per day, a lower annualized cost, and I control the risk to single digits. Why is that important? Because as we already showed, if I take a 5% loss, I only need a 5.3% gain. If I use an out-of-the-money put that's cheap and short-term, you get what you pay for, just like any form of insurance, meaning that that risk would be higher to the 10, 12% range because the stock needs to fall before that insurance kicks in, and that 80 cents or 90 cents of time value is piled on top of that intrinsic loss as well. So our goals are all the same. We want to make profits consistently. We want to control the losers. We want to allow the winners to run and make sure that we're in a structure that cuts the losers short. You never want to overtrade or overinvest. Some of you may have bought calls and saw some gains, and then you were buying maybe 5 contracts at a time, and you thought your structure and your criteria for technicals and fundamentals were solving your problems. So the next trade you jumped in with 20 calls on something you thought was a positive bullish stock, and the stock fell. You overinvested. What I just talked about with the time value, when the shorter term options have a lower time value but a better annualized return, as options investors, whether we're doing spreads or covered calls, callers even, or buying calls, speculating on a market movement or buying puts, we're manipulating time value. We're looking to buy options that decay less slowly and sell options that decay more rapidly. Okay? So those are the basic rules of any option strategy. So with that in mind, we saw where our three positions roughly are today, or two positions are today. We talked about April 26th. We saw the stock at 72.50. And the current price today was at 78.25 the other day, but we saw it at 77.95 before the webinar started. So that stock's up 7.5%. Our covered call is looking real good. Bull put credit spread's looking very good as well. Okay, so what we do here at Radioactive Trading is we're going to focus on limiting risk first. We're not going to use the put option just as insurance, even though that's what it is. But structured properly, we're going to be able to manipulate the time value of our favor. Okay, so rather than what we talked about of purchasing the stock and purchasing just out of the money put 1 month out, we're going to take a stock or an ETF where our expectation is the stock's going to be bullish, it's going to move up in price. We're going to look to purchase a far out in the money put option to put the time value in our favor and to take advantage of the option that's 5 and 6 months out in time not being 5 times the cost. I'm going to buy farther out in time and slightly in the money instead of out of the money for the lower cost. This is the structure that allows me to limit the risk to single digits and still be able to profit. Now, it's all good in theory. What about in practice? Well, here we are, April 26 once again. Our same stock, AAIS, is trading at 72.50. On April 26, opening a radioactive trade, I would have purchased shares of stock just like the covered call investor at 72.50. And at the same time, I would have bought an October 75 put for about $6.85 during the trading day. I think it was a $7 at the close, but about $6.85 during the trading day. Okay, now that does mean what? Well, instead of lowering my cost, I think it was down to $70.95 that we did with the covered call, I now have a total investment of $79.35. But remember the structure. Here, because I paid the money to buy this put, I own the right to force someone to buy my shares of stock at $75 anytime between now and expiration, which means what? The most I can lose on the position is that difference, $4.35 of my investment, or 5.5%. Even if I took this maximum loss. Remember, I'd only need about a 5.8% gain to get back to break even. Whereas you take a 50% loss on your credit spread, let's say 225 or so, you've wiped out 6 or 7 previous trades. And if you take a 10% loss on a conservative covered call, you've just wiped out 5 previous trades. This here puts me in a proper structure where I focus on limiting risk first, rather than looking at the return. But again, this proper structure means I'm leaving the upside open. So you look at that structure and you're going to have questions, comments, and you're going to say, look, I understand what you're doing protecting the stock. You're insuring the stock, that's true, but you're adding too much cost to the initial stock price. We bought the stock at $72.50. We bought a in-the-money put for $6.85. I'm almost paying 10%, adding 10% of the underlying stock price to this position. Well, that's true, but we all know the cost of not having insurance, especially in the unexpected events when the stop order failed you. The other argument is I'm taking away from gains because I paid too much into the put and my gains are going to be limited. Well, that's not exactly true. Now, sure, there is a counter to it, but it's not one-to-one by any stretch of the imagination. And, oh, I'm sorry. This is the last one I didn't adjust here. My apologies on that. we looked back at the break even, my cost basis of $79.35. Okay, and you're going to say, well, you're not going to profit. You're not going to make any money until the stock goes above the break even. With the covered call, we bought stock at $72.50 and lowered our cost basis by $1.55. So now we have a lower break even. We don't want a higher break even on a bullish position. We want a lower break even. Well, that's not true because the put doesn't go to zero. The value of the put doesn't disappear. It's not like your monthly home insurance where you pay for it and then you don't see any of it back. When I buy that far out in time put at 685, the moment I entered that position, I could turn around and sell it. I could sell to close the stock at 72.49 and sell to close the put for maybe 675. All I'm risking when I open this position is the bid-ask spread of the put. Not losing anything. My position is not down $4.35. All right? My position is not down the 685 I paid for the put. I'm not 685 behind the 8 ball. The proper structure gives me a guaranteed limited risk even in the worst case scenario. Unlike the covered call and the bull put credit spread, we leave the upside open. I'm not down 5.5% at the beginning, remember. That was the maximum loss. That maximum loss would only occur if I hold the position all the way to October expiration. I make no adjustments. I can still sell calls against this structure and lower my risk. I can do other things to this position to cancel all of the risk, what we call bulletproofing the trades, where I have no risk to the downside and still have an unlimited upside profit potential. But the only time I would take this full risk is if I held this structure all the way to October expiration, made no adjustments, accepted no dividends if AIS paid a dividend, and the stock was trading below $75 per share. Okay. James, I'm going to get to that in about 10 minutes. James says, why would you sell your put? I talked about selling it when it is your protection. No, I'm saying that the moment I open the trade, I'm not down 5.5%. I'm not at a loss of what I paid for the put. All I'm risking is the bid-ask spread. Why would I ever sell the put? Because I can get a better structure if the stock does what I want with a lower risk by manipulating the time value in my favor. Okay? So is this trading against myself? If I'm bullish on a stock, why buy the put? Why pay that extra money? Well, it's to protect against the unexpected. A black swan event, if I'm wrong on the stock. Okay? Why am I increasing the break even? Because the break even is only important at expiration, and I'm not going to hold this position all the way to October expiration. And even if I did decide to, which I would never hold the put all the way to expiration when that time value decays out of it in the last 45 days or so, I'm still going to make adjustments against the position to attempt to lower that risk. Okay? So we don't know the return. We know the guaranteed risk. The worst case scenario, very worst case scenario, is losing 5.5%. So isn't the covered call or spread better because you know your return up front and you lowered your break even? Well, it might be in this case, and it might be over time, but not really. Now, what we're going to show next is the comparison of our three positions, but also focusing on something else. That protective put, along the lines of what James says, serves two functions. Number one, it ensures our stock positions against unexpected declines, and it's guaranteed, unlike an assumed stop order. That put in the proper structure of a radioactive trade that's far out in time is its own asset. It doesn't go to zero the moment I open it. It doesn't go to zero if the stock moves up. That initial put can be manipulated, the time value as the stock moves up and down, to limit the risk further and reduce the cost basis, in addition to other adjustments, such as simply selling a call or doing other structured options trades in the proper context of this protected stock position. There are spread trades I can do inside of this that take on no risk because of the structure of the trade. All right, so now we're going to go over to power options, and we're going to look at these three positions, okay, where they stand right now. Now, here's a view. Let's see, it comes up there, and let me pause that for a second. I'm actually going to do something here. Oh, there we go. Okay. All right. So let's go ahead and take a look at the screen here, and let's see if this works a little bit better for us. There we go. Hopefully that's a little bit better. But here's the married put we discussed, purchasing the shares at $72.50, and then October 75 put at $6.85. That's the top line. Covered call is next. Entered the position at $72.50. We sold the May expiration 75 call for $155, expecting a 5.7% return if assigned if the stock moved up as we expected. And here's our bull put spread. We sold the May 70 for $1.45 and of course paid 75 cents for the 65. Now I'm going to scroll over, and what we're going to take a look at here are three positions. Married puts on top, covered call is second, and the bull put spread is third. So where do we stand? Our current liquidation value with the stock up 8%. Okay, it's trading at 78.21. It moved up further from the 77.95 I was looking at, but the stock right now is at 78.21. This is within the last update about 15 minutes ago. So I bought the put at 685 when the stock was at 72.50. The stock's now at 78.21. My put is still worth 475. Why? It's out of the money by 3 points, but it still has 5.5 months of time premium remaining. Okay, so when I open the position, remember the profit and loss chart, we had a risk of 435. I paid 685 for the put. But when I purchased the 75 put, it was $2.50 in the money. So that means I had $2.50 of intrinsic value on the put, and that max risk, the 435, was the time value. This is what we call a phenomenon of the ATM bell curve. What happened? As the stock went above my put strike price, it went from 72.50 to 75, now to 78.21. Is my put down $2.10? Yes. I lost intrinsic value on the position. But the time value, the extrinsic value, is now 475. I actually gained 40 cents of time premium on the position. And it's a phenomenon we talk about in the blueprint, which describes the full technique of the at-the-money bell curve, where options that are at the money always have the highest time value. So this is an out-of-the-money option, but the time value actually, the extrinsic value, increased from 435 to 475. Did I lose 210 on the put for intrinsic value? Yeah. But I gained 571 on the stock. So what does that mean? It means right now, I could sell to close the stock at 78.21 and sell to close the put for 475, even though it's out of the money. And we see that our liquidation value is 361 or 4.5%. Am I at 79.35? The break even? No. Because the structure of the trade, the put had a negative delta, but it was only around 0.4, 0.5. So for every dollar the stock moved up, I only gave back about 50 cents to the put. And then the delta keeps decreasing. So here, without being at break even, I'm already at a profit of 4.5%, just about half of what the stock has gained, a little bit more than half of what the stock has gained. What about the covered call right now? Well, it's in the money. 8 days from now, if it stays above 75, we could make 405 or 5.7%. But right now, if I liquidated it, I'd have to pay 360 to buy to close the call. And then we could sell to close the stock at 78.21, so we're making 336 or 4.7%. I've actually made almost $30 more monetarily on the married put than the covered call. Now the bull put spread is essentially near full profit. Fantastic. We're at about a 16.3% return. We could close it right now around midpoint for 10 cents a piece, and we'd make almost the full credit of $70 or 100%. Now, of course, you probably would have done 5 contracts, and this might be at 350. But remember, with 100 shares in one put, I'm only risking $435 on the married put position. If you did 5 contracts of the bull put spread, that at a 430 risk, you're risking about 2,200, 5 times the monetary risk that I'm taking with the married put position. So is it capital intensive? Yes. But what are the benefits of insuring it? I have a controlled risk of 5%. I can still, oh, okay. Rob asked a question. I wonder who, I'm pretty sure everyone can answer this for me. Rob says, what about all the commissions? I didn't factor commissions into this trade, either of these trades, because it's a wash. If I did a married put, I bought the stock and bought the put, well, I'd have a commission of around $11.90. If I did a covered call, I bought the stock and sold the call, I'd have a commission of about $11.90 if I legged into it. And if you did a credit spread, where you're looking to make 70 cents if I did one contract, well then the commissions would really take hold. So let's say my broker gives me a break with the spreads and I only pay $7.95. Well, that's 10% of a one contract trade. You can say, oh, well, my broker allows me to do a buy right, so my commission is only $5.95, or let's call it $6.70 instead of the $11.90. Yeah, well, most brokerage houses give you the opportunity to leg into a married put as well, where the commissions are $6.70. So why didn't I include commissions? Because it's a wash. It's the same. These are two-leg positions. I'm not paying more commissions entering a married put than you are for a covered call. It's the same for me at Fidelity. If I leg into it as a married put, the commission, I think around $8.70 actually, is the same if I did a buy right. Okay, and for a spread trade, it might be $7.95. Let's say interactive brokers, you say, oh, well, they offer lower commissions. They do. But the commissions for entering a married put, a two-leg transaction, buy stock, buy put, the commissions for doing a covered call, buy the stock, sell the call, and the commissions for the bull put spread would all be about the same. Okay, there's no difference here. I'm not paying more for commissions, not at all. And you say, well, okay, well, I could get a higher return on the covered call by rolling it. I'm going to show you how I can get a higher return on this position by rolling it too, making a quick adjustment on the position. And again, if you roll the covered call, it's going to be the same commission for me making an adjustment on the married put positions. They are a wash. Okay, that's why I'm not factoring commissions. So again, just to answer your question directly, Rob, this 361, what if I paid $10 to enter the position? I've got a monetary profit of $351 on my married put. I'd have a monetary profit of $326 on my covered call instead of $336, and $10 commissions for the bull put if I did one contract, which I know we wouldn't. But then the $10 contract, $10 commission would put me down to $60. Okay, so what if I did 5 contracts and had a $10 commission? Well, you would have taken in $350 minus 10, which would be $340. Now, percentage-wise, you're doing gangbusters, but monetarily, the married put is still higher right now. Okay, so you're not, what I'm showing here is that we can argue about the leverage, we can argue about this, but what I'm showing is the monetary gain for a covered call and a married put, if the stock moves up as you expect, is going to be about the same. And this was a speculative covered call. Most of you probably would have sold the 70 or the 72.5 at the money to get only a 3% upside return maximum, or maybe a 2.2% with the in-the-money covered call of more protection. But again, that's capping the upside. Okay, so that's just a comparison of where we stand right now. It's performing just as well, if not better, not considering the leverage on the position. But then again, this isn't how it happens every time, is it? Oh, sorry about that. There we go. No, this is not how it happens every time. We know that. What if we took a similar position on the same date, April 26th? Ubiquity Networks, UBNT, was trading at 51.42. Today the stock's fallen to 46.80. So with what we looked at right there, AEIS is up about 8%. UBNT is down $4.62 or 8.9%. So we've got an 8% gain here, about an 8-9% loss on another stock. All right. What about our structures? Well, we're near the end here, and I still want to show one more thing, so I'm not going to show the actual trades. I can real quick. But, all right, I will. I'm sorry. Let me go back here. I have it there. It'll take me just a second. So we'll go ahead and show the 3 trades. On UBNT, if I did the same ideas, okay, the same concepts, how would I have opened a position? Well, for the married put, I would have bought shares of UBNT at 51.42 on April 26, and I would have bought the September 55 put for 665. This gives me a risk of about 5.6% on the position. Your covered call, you might have bought stock at 51.42. Speculating in the same out of the money, you could have sold the May 55 call for $1.40. So if the stock was above 55, you would have made a 10% return on your investment. And then, of course, the high probability spread. You might have sold an May 50 put for 205. And this isn't that high probability, but you would have bought the 45 put for 70. Okay, so you make a credit of 135, which on a 5-point spread is almost a little bit above a 35% potential return. Okay, so with the same kind of out-of-the-money structure, similar probability on the bull put spread, though I'm sure some of you would have done the 45 versus the 40. By the way, that would have only given you an 8% yield on the bull put spread. But we expected a 10% return on the covered call if we were assigned, and we're expecting a 37% yield with about a 65%, 67% probability using the 50 to 45 bull put with a stock at 51.42 for today's expiration. Those are the 3 structures. Risk of 5.5 on the married put, unlimited upside profit potential. Oh, actually, I'm sorry, I think it's higher. I'm sorry. Let me just take a look at the number real quick. I'm going to go to the profit and loss chart. Oh, it was 5.3, 307, okay, was the maximum loss on the position, okay, for UBNT, all right? And right now we see that the loss is 197, or about 3.4%. Okay, it changed a little bit because the stock moved up to 47. Anyway, but that was it. The risk was where I thought it was, 5.3%. Okay, so why is that relevant? Well, again, let's think back to our trading strategy. If I'm doing covered calls, similar technical and fundamental indicators on April 26th. On AEIS, we open the covered call. Right now we have a gain of 336, 4.7%. We saw that on the liquidation value. Before the webinar, I looked at UBNT. The loss was at 320, or 6.4%. It's about the same right now on that position. Okay, so what does that mean? Well, you're still profitable, the 2 combinations, but you're profitable by 16 cents or $16. Okay, and if UBNT continues to fall, that loss might increase. And remember, you can't gain any more. You'll gain a little bit more on time value decay on AEIS, but you still have the capped gain. And what about the bull put? Well, made a gain of $70. The maximum loss on UBNT, of course, was closer to 365. But remember, the stock's at about 46.80. It's between the strike prices. It's not below 45, so you're taking a loss of 173, but that's over 2 times the win. So this loss, if you liquidate it right now, you didn't take the full loss, but you've wiped out 2 or 3 previous gains. That's the lie of leverage with spread trading, is one loss is going to wipe out more. On your covered call, you're about even. Bob, if you factor in commissions here for buying the stock and selling the AEIS call and doing the same at UBNT, well, if my commissions, let's say, were $870, I'm sorry, that's terrible. If my commissions were $870 for a buy right in this situation, well, that means I'd have $1740, so I'd actually be at a loss when I factored in commissions to the covered call. But what about the married put? Well, we see right now, since the stock went up, the loss was only 197. But when I looked at it with the even numbers, where we were with the bull put and the covered call, right before the webinar, we were up 361 on AEIS, or 4.5%. And even with the stock falling 8%, I'm not at the max loss of 5.3. I still have time value on that put, so the loss was only 220. So here I am with 2 trades. One went up, one went down. The covered call's at a little profit, break even, but a loss if you factored in the commissions. AEIS, you've wiped out 2 or 3 previous trades, more if you factor in the commissions. And AEIS is holding a gain of $140, which might only be $128 if we factor in the commissions, but it's the only one that's profitable. Now again, I'm not saying your win-loss ratio is going to be 50%, but remember what we showed at the beginning of the webinar on the trade simulator tool. A covered call structure of looking to make 3% when you're right and factoring in a stop order of 7 or 8%, you still needed to be right about 73, 74% of the time in order to profit long term. A bull put credit spread, even if you're looking for those higher probabilities of 80% or more, which probably means you're taking a 9-to-1 or 10-to-1 risk-reward ratio, that means you actually need to be right 90% of the time. One loss could wipe out 10 previous trades. And if you take 2 losses, even if one of the losses was only 50% of the max loss and one was at the max loss, you probably just wiped out 15 trades. Right? You're back to below break even. You've got to get back and have 15 to 20, maybe 25 positive trades in a row to get back to break even. So the 80% probability means you actually need to be right 90% of the time. The structure of a married put, of controlling risk, putting time on your side, the initial structure of a radioactive trade. So we keep the single-digit risk. The put doesn't go to zero, so I'm not buying a put month by month by month, which would increase my annualized return. This is the only trading strategy I've seen, even in standard collars that we reviewed a little bit briefly before, or I might be looking for a gain of 2% but risking 3.5% to the downside. The proper structure here of the married put is the only strategy I've seen in roughly 15 and a half, 16 years of trading where I could actually be wrong more often than right and still make money because of the structure of the trade. So why should I insure my stock? Well, obviously to control risk, but also to be able to use the proper structure of insurance to manipulate time value, still be able to do other common option strategies you're doing right now in the proper structure. Okay, now what do I mean by that? Well, let's take a look. We talked to James earlier about why would I ever sell a put because it's my insurance. You know, I wanted, and then there was another comment in, well, you're not counting in the premium that we're taking in for the covered call. Yes, we were. We showed the loss, the cost basis being dropped down to $70.95. Okay, but I want to go back to the married put. I want to take a look at our AEIS position on power options very quickly. We're going to take about 5 minutes here. I know we're 7 minutes past the time. But I want to take a look at the structure of the married put profit and loss chart and show you a couple factors, okay? All right, so let's go ahead now, take a look at the profit and loss chart of our position. Here's the AEIS married put. Remember, we paid $72.50 for the stock on April 26, and I could have bought an October 75 put for about $6.85 or $7. The risk is dialed in. The worst case scenario is that I could lose 5.5% on the position. Remember, that'll typically only happen at October expiration. This break even only matters at expiration. Okay, because if the stock moved up $1 from when I bought it, which it has, but the day or two after I open, if the stock went up to $73.50, my put would have only dropped 50 cents. I would have had a 50-cent profit on this married put. And the stock's nowhere near that $79.35. Now, our risk on this position monetarily is $4.35. What does that represent? That represents the time premium. When I bought the 75 put at $6.85, $2.50 of that was intrinsic value. I was guaranteed to get that back. The $4.35, the remainder of that $6.85, was time premium. But now the stock has moved up. So what can I do? Well, let's go to October, and there we go. We see we've got a bid-ask spread of 420 to 490, 70 cents. So at midpoint, if I got midpoint, which I usually get when I enter these trades, let me add the 75 put back in, and I'm going to sell to close this put for 455, right? That would be the midpoint. Now, am I down 230 on the put? If I close this right now, am I at a loss of 230? Well, on the put, my stock is up $6.10. So I'm still at a $400 profit on the position. But James says, why would you ever sell it? You're going to cancel your insurance. What if I do this? If I move the put up a strike? Okay, so I'm selling to close this position for 455. I'm going to buy an 80 strike put for about $6.95. We'll call it $7, okay? Right about midpoint. 30 cents below the ask, 40 cents above the bid. We'll do it at $7. What am I doing here? I'm adding $245 to my cost basis. Right? That's going to be a debit. Now remember, this is already factored in the $79.35 total cost, the original put price. Selling to close my put now, where I've gained 20 cents of extrinsic value from where I bought it, and then buying the higher strike put at 7, we pay a debit of $245 to get a 5-point guaranteed higher exit. So I'm actually lowering my risk by $255. Why would I sell the put? Well, to manipulate that time value that's still in my favor and still exists, to pay a smaller debit to get a higher guaranteed exit. So I'm paying $245 to get guaranteed 5 points higher back. All right, so let's go ahead. Where are we now? Did I increase my cost basis? Yeah, it went up to $81.80. But now my risk is down to only $180 or 2.2%. I'm shallowing this line. Did I hurt my position too much? Well, not really, right? Remember, we could liquidate the position right now for a gain of about $361. So I do this roll. I increase my cost basis to $81.80. Well, I turn around and I sell to close the stock at $78.61. I wouldn't do this. And then I sell to close my put. Let's say I just got $660. Okay, where does that put us? Well, that puts us at about $85.20 for the position with a cost basis of $81.80. So I'm still up $340. Even after doing this roll, I could turn around and liquidate it and still have that profit of close to where I was. Okay, so I paid this swap here, reduces my risk to 2.2%. That's why I would sell the put. That's one of the 12 what we call income methods, adjustments we use off the married put to either generate income, lower the initial at risk, which we did here, and potentially bulletproof the trade, which means I cancel all of the risk to the downside. Can I do that now? Well, let's take a look. I own the stock. I've protected it with a put. I've already showed you how the insurance doesn't go to zero. And now, why not? Well, not 8 days left, but let me look at June. The 80 strike call, 180 to 210. So let's say I can sell that now for 195. What was my downside risk originally? Well, was 2.2% on the position. Okay, now I've reduced it to where this position is bulletproof. I still have the max potential profit of 7.2%. Then about a 60-day time period from April 26th, I'd call it maybe 45 days, to June expiration, June 16th. Okay, so about 45 days, 7.2%. That matches my trading goals. No risk on a position. No risk. The stock could drop to zero. What happens? I can sell to close my stock at $80 because I own the put. My cost basis is only $79.85. Worst case scenario now is I can make 0.2% on this position. What about the commissions here? Not much different than rolling up a covered call, is it? In rolling a covered call, you got to buy back the call, so you'd have to buy back your 75 call on AEIS, roll it up to the 80 strike. Okay? I rolled a put, same commission, and I just added an extra commission by selling the call. Okay, sure, but it's a guaranteed profit, no risk position, still 7.2% return to the upside as well. Herb, this is a question that relates to our 3 core principles of radioactive trading. Herb asked a question. He said, the extrinsic value of a put does not always go up in your AIS example because of theta decay. That's why I bought a 5-month out put, because if the stock moves up as I expect, the true theta decay, the rapid theta decay, the time value decay on the option won't kick in until the last 45 days. I might lose 5 or 10 cents in the next of time decay in the first 15, 20 to 30 days, maybe 20 cents. But that decay that's why I'm buying far out in time. If I had bought the near term, hey, I would have lost it all. All right? But because I bought 5 months out, look up the time value decay. It looks like this. I didn't have it here. I actually had it in the slides, but I skipped over it, so we didn't just go into the basics. This is the time value decay curve of an option, assuming everything is the same. This is 150. This is 120 days out. Here's about 90. Here's about 60. Here's 45. Here's 30. Okay? So I bought a put option, October. It was more than 5 months out in time. So even if the stock moves up, that decay is not going to be rapid until I get to those last 45 days. You can look up time value decay curve and you'll see this graph all over the place, Google Images or anywhere else. We've got it archived in other webinars also, okay? All right, James says a married put is similar a married put is similar to a covered call because you're renting it out. No, 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 no. If I bought the stock and sold a covered call, I'm renting out my stock. Okay, I have an obligation to deliver it. Here, I'm renting it out, but it's with insurance in place. Think about it this way. Instead of buying a house and renting it out month by month to cover the mortgage, which is a covered call, I bought the stock and insured the position and live in it, knowing that I can't lose more than 5 or 6% of the value of the house, even in the most catastrophic of disasters. And then I could still choose to rent it out a month or two here or there and lower the cost basis of my insurance premiums. That's what a married put does. It puts you peace of mind. It puts you in the proper structure of the trade as well. Okay, so a follow-up question real here, and then I've got just a couple more slides to wrap up here. Dan makes a comment. You stated regarding covered call writing and other strategies, if this works so well, why wouldn't everyone do it? Because it doesn't. And Dan says, I understand the benefit of the married put strategy that you outlined, but couldn't the same question be asked, why doesn't everyone do it? And why doesn't someone like you set up a fund that does this strategy if it regularly yields above average returns? Well, I don't need to set up a fund to do it. And Dan, there are funds that do it. Read any prospectus you get from your broker about mutual funds you're in. Go to the very back page or maybe the second to last page, very small print down at the bottom. You'll see a paragraph. The fund manager will occasionally enter into married put and collar spreads at times of a fear of a downward market for the holdings of your security positions, or something along those lines. They do it too. Why isn't it taught? Well, who profits more if you lose money on a covered call, a bull put credit spread, or a structured trade? Well, you lose, but who makes money? Someone else. Why are covered calls touted as it makes no sense to me. By the way, when you first apply to trade options, even in this day and age, Dan, the first thing they're going to put you in is level 1 trading. What does that mean? You're allowed to do covered calls, meaning you're still risking 96 or 97% of what you invested in the stock to cap the gain at a 2 or 3%. Who wins on that? Okay. Why wouldn't they let you do a married put at the beginning at level 1 trading, where it actually is a safer trade, where you can control it? Why do you need level 2 to actually properly insure your stock holdings with a put, which is much better than a stop order, which gets a lot of investors into trouble? I can't answer that question. Why aren't more people doing this? More people are doing it than you think. They're hidden in that little fund managers section. Anytime you've had a fund manager or even an advisor, maybe Ameriprise or some other fund out there, Edward Jones, things like that, if you looked at the true portfolio for a 12 or 15-month period, there were times where they probably bought puts on the stocks outright, maybe did a collar spread to generate income to pay for the put, it's been done. So why isn't everyone who's trading out there doing it? Well, let's be honest. What I'm showing you to be profitable long term, when you control the risk, where you can even be wrong more often than right and still make money because of the proper structure, it's not sexy. Why am I doing 1 to 2 webinars a week trying to show people the benefits of doing this? Is because it's more sexy to tell a person, hey, if you own stock, sell a call against it and generate 5% of income. Don't worry about the downside. It'll come back. That customer, or sorry, that service I mentioned, that's touted. You could make 3 to 6% per month on covered calls going forward. Okay. They would tell you, they would yell at people in their seminars, I've heard, and even on the phone. You'd get yelled at if you said, well, what about the downside? They would tell you that you don't even need to worry about the downside. The downside's irrelevant. If the stock falls, it'll come back up. You keep selling premium against it. No. The simple slide I showed a while ago, why are we in this? We're in this to make money. So if I open 5 covered calls with a 3% return if assigned potential, and one of them drops 25%, and I make the full profit on the other 4, I'm losing money. That's not good. That's not where I want to be. Okay? So that is the idea. Okay? And that's why people don't do it. And why isn't it done more often? Because it's not sexy. I have financial advisors that use power options and use this technique. And I talk to them on a fairly regular basis, and sometimes it's to help them explain to their customers that they're managing their money for, why am I adding money to the position? Right? Why did I structure the slides this way, Dan? It's because people see that and say, you're adding money to the position. You're not going to make a profit until it goes up this high. You're not going to be able to make a profit unless you see a 10% gain. That's not true if it's properly structured. Okay? And it's not sexy. But your portfolio will look sexier long term by controlling your risk to single digits. Okay? James says married puts are not done as much when VIX's volatility is this low. Now I think is the perfect time to do it. What is the more common question I get, James, over the past 2 to 3 months? The question has been, oh, I'm sorry, folks. I just meant to go on here. There we go. Let me go back a minute here. This was for Didi. Okay. I'm sorry. The question has been, are we at the market top? I don't know. But you know what I do know? Let's say I bought AEIS at 72.50. And I just had a 5% stop order, and now the stock's at 78.61. Do I want to put on a trailing stop? Maybe. Or would I rather buy an 80 put now to protect most of that $6 gain I have in the stock? Maybe even bulletproof it right now after the fact. And even if the stock falls, I've still locked in some of that profit. Maybe even more than 50 to 60% of that profit. Whereas a trailing stop, if it slips, I set it at 75 and it slips and it drops down, okay, so I'm still made 250. But I could trade as though I called the market top because I locked in most of the unrealized gain now on a stock I'm holding that's up in price and left the upside open, okay? And that's the case. How does volatility affect this strategy? The same as any other strategy, okay? So, but a little bit differently. If volatility increased and the market went a little haywire, if you're buying a cheap, out-of-the-money, month-by-month put on a security you're trading long-term, guess what? You're paying much higher annualized than I am. I can still buy the 5-month out put, and it's not going to be necessarily as nearly affected by the volatility in the price because it's further out in time. 6 months, 8 months, and 5 months is just, the starting point. I can buy a 10-month out put, which won't be affected by near-term volatility, still have a 5% risk. But guess what? Now maybe like a calendar spread, but without the leveraged double-digit risk on a calendar spread, I can sell the near-term increased implied volatility in different ways to cut down the risk faster. Okay, so it works the same way with other strategies. But remember, what do you know about an 8-month, 10-month, 9-month out option? It's not as affected by the near-term volatilities. That's where we want to buy for the proper insurance, okay? And that's the idea. So, Dia had asked another question, what are the 12 different income methods? Well, we don't teach all 12 income methods for free, Okay, the full product of where you can learn all 12 income methods, the proper structure, is only shown in the blueprint or what's called the home study kit at Radioactive Trading. That is the full product of the proper structure of getting into this correctly, because there is a way to take on too little risk. If you buy a put that's too deep in the money, you might find a risk of only 1% or less, but your expectancy of profit is going to drop down to near zero. There is a proper structure of what to look for with the initial setup to still have a reasonable and profitable expectancy going forward. Okay? All 12 different income methods. There's other adjustments we can do with the put to manipulate that time value. I can actually do spread positions, spreads you might be using right now, even ratio call spreads in the context of this protected position where it doesn't add any risk. I still lower the risk on the married put, but I don't take on the additional leverage risk I would of doing a spread trade on its own, because it's done in the proper structure. There's income methods that work if the stock moves up, as we showed today, manipulating the put in our favor and still taking advantage of selling a call, which you might be doing right now. There's also income methods that work if the stock stagnates. Why is there 12? Because some of them are used if the stock moves up. Some of them are used if your stock doesn't move in the first 25 to 30 days or maybe 40 days you're in the trade, where you can still reduce the risk on the position. There's even ways to lower the cost basis on the position if the stock falls, and income methods that show you how you can profit in both directions if your expectation is you're wrong and the stock's going to continue to fall as well. So the blueprint shows everything. And if you're serious about the blueprint, you should check out radioactivetrading.com/iridium. We've got a series of 5 special bonus offers we're running right now. If you pick up the blueprint, we'll send you what's called the Quick Action Guide. You'll get one of Kurt's Mastery Series CDs, the Foundations of Radioactive Trading CD, for free. The Fusion service, which I didn't get to talk about today, but you can see which positions I'm trading and that Ernie are trading in the Fusion account, as well as have access to other tools for radioactive traders. You'll get your first month of Fusion for only $10, usually $69 a month. And some of the power options tools I showed today, of course, well, there's a lot more tools available. You'll also get a free month of the power options tools to search and analyze positions. We support patented tools in over 23 of the most commonly used strategies, but most important, all of the radioactive trading concepts. And of course, anyone who purchases the blueprint gets a free 1-hour sort of session with me to go over the ideas, and you can do that at any time. Just like the free month of power options and the free month of Fusion, you can take the session, the month of power options, or the month of Fusion when you're ready. You don't have to start them right away. You can take advantage of them at any time after you pick up the blueprint and start going through the material. So if you go to radioactivetrading.com/iridium, IRIDIUM, you'll be able to take advantage of these 5 bonus offers, and the blueprint also comes with a money-back guarantee. If for whatever reason you start going through the content and you feel it's not for you, right? Maybe you feel the market conditions aren't right, or the timing's not right, or something comes up and you feel that you're not going to be trading as much, well, in that case, I'd hold on to the blueprint until you're ready to start trading. But if for whatever reason you're not satisfied, you can ship it back to us and we will fund the full purchase price. Okay? Also, members who buy the blueprint get access to the members-only webinars at Radioactive Trading, Blueprint members-only webinars, which talk about different ideas and concepts as well, and also different articles that we've written for Blueprint members only. And even if you don't want to activate your coaching session, anyone who owns the blueprint also gets free phone and email support. You want a second pair of eyes on your trade? We can't tell you what to trade. We can go through the pros and cons of maybe a married put structure you're thinking about, an income method or adjustment you're thinking about on the position as well. So that's all available for the Pick Up the Blueprint. You get those 5 special bonuses if you go to radioactivetrading.com/iridium. It does come with a money-back guarantee, so you're starting off with a no-risk position already. You'll have access to the members-only webinars section and other articles as well. And you'll also be able to call us or email us anytime with any questions that you have. All right, so what's next? Well, I did record today's presentation. We'll post it in a few hours, and we'll let you know when this is available at radioactivetrading.com, where you can review the presentation. And then if you have questions at any time, you can send me an email to support@radioactivetrading.com. Remember, you can also call us at the office during market hours at 302-992-7971. If I'm not available, Ernie or Greg or one of the other staff members will be able to help you out as well. Okay? All right. Well, ladies and gentlemen, I want to thank you for joining me today. Hope you all got some useful information out of today's presentation and have seen why you should consider insuring your stock, because it's not just insurance that disappears. You know, that AIS position and even the UBNT that dropped, even though I had paid for insurance and the stock had fallen almost 9% on UBNT, the max risk of 5.3% is not reached. I still have the time premium available, so I'm only taking a risk of 3.8%. But on AIS, we showed that even though I paid $685 for the put, it's not just insurance, it is an asset. I can still now manipulate that asset to put myself into a structure where I have no potential for loss to the downside, still can meet my upside goals on the position, and go forward through any event, earnings, black swan events, unexpected events, or anything else without fear. This gives you total control and total peace of mind for your positions, because you know that the worst case scenario is you could lose 5, 6, or 7% based on your structure of the trade. Okay, ladies and gentlemen, thank you again. I'll let you know when the webinar is posted so you can review it later. Have a great trading day and the remainder of your trading week, and I hope to see you soon. Good night.